Welcome back to Confident Real Estate. I'm your host, JC. Today we're going to talk about one of the greatest advantages that real estate investing can provide to you. And that is something I talk about quite frequently on this channel. It's called capital appreciation. I'm sure if you've watched this channel before, you've heard me talk about the benefits of capital appreciation. Well, today, that's the point of this video. We're going to review exactly what capital appreciation is, why it's so incredible, and we're going to give you an example to illustrate the real benefits, financial benefits that it can be providing you. But before we do, please do me a favor and hit that like button down below to feed the YouTube algorithm. And if you're not yet part of our Confident Real Estate family, come join us. We want you. Please hit subscribe, at least consider it. We'd love to see you around and hope you get a lot out of this video and a lot of our other content that we already posted and that's to come. All right, let's get into it. If you know anything about savings and investing, whether through dividend stocks or an IRA or 401k, what have you, then you're probably well aware of what the term compounding interest means, because it's one of the most beneficial factors and most powerful parts of long-term investing. Compounding interest is how you grow wealth. Well, in short, capital appreciation is the same as compounding interest, but just in the tangible asset form of real estate. That's all capital appreciation really is. Many of you are also familiar with the term Bur Method of real estate investing, which is an acronym that stands for buying, rehabbing, renting, refinancing, and of course, repeating. To give a quick example, the Bur Method of real estate investing would require somebody to buy a property that needs some real serious work, whether structural or cosmetic. Maybe the inside of the house doesn't look like it's been touched since 1950. Renters aren't really interested in paying market rent for something that looks so dated. So you come in and you buy the property, theoretically, for a discounted price. That's the B in the Bur Method, buying. And then you do the R, which is rehabbing. You spend some real money to renovate that whole property. Then you rent it out, the second R, and then you have a market rate tenant in there who's paying you a nice cash flowing return on your investment. And then you go to the bank and you refinance the property. That's the next R in the Bur Method acronym. And that refinance allows you to pull out all or most of your cash that you invested into the property. And now you own a property that's cash flowing with the tenant in place that you have very little of your own money in, because the refinance value of the property is significantly higher than what the property was worth before you did the rehab work when you first bought it. And then, of course, the last R is go and repeat it. The refinance portion of the Bur Method is a great example of capital appreciation, and in fact it's often referred to as forced appreciation because you have put in some sweat equity, time, money, and effort to renovate a property to bring up the value, and you're gaining that appreciation and equity value in the property because of the work that you have forced upon the property. When you go and refinance, now that the property value has increased because of your work and your renovations, you can pull that extra equity value back out in the form of cash. And then you go and repeat the process. Let's say you bought a house for $100,000 and you put $25,000 into the renovations to bring the house up to where you feel it needs to be. And maybe you put 30% down because it's an investment property and you took out a hard money loan, which means high interest rates, for the remainder of that purchase price, the other 70%, as well as the $25,000 in renovation costs. Or maybe you got a traditional loan at 70% loan to value and you put 30% of that $100,000 down as a down payment, and you put the $25,000 in renovation costs on your credit cards. Either way, you gotta get those debts paid off and get the cash you invested back out so that you can go do this again. Otherwise, you're gonna be stuck there for a long time in that one property. So you go out, you get a tenant, they pay you $1,500 a month. Now you've got $18,000 a year coming back your way in positive gross cash flow. It's time to refinance. So realistically, now that the property is renovated and rented, you want to go and get a traditional mortgage loan from your local bank. And they're going to come out and do an appraisal. And you've done a good job on your renovation, so they appraised the property at $185,000. That is $85,000 more than you just paid for the property when you purchased it. So good job on the renovations. But They also know it's an investment property, and they're only going to give you 70% of the after repair value, that ARV. 70% of the value of the property after the renovations you've put into it. But that's okay, because at $185,000, the 70% of that value is still $129,500. That means you can pull out $55,500 in cash as part of a cash out refinance so that you can go do your next deal. Remember that you spent $30,000 of your own money plus $25,000 in renovation costs to buy and renovate the property. So after closing costs on the new loan plus the costs that you incurred when you closed on the initial loan to buy the property, and calculating the carrying costs you had for real estate taxes, insurance, and loan payments on the initial loan during the time you were actually renovating the property, which let's say was anywhere from 3 to 6 months, hopefully closer to 3 months. That's time and money that you had to spend to pay for those things before you actually had a tenant in place who was paying you a monthly rent. And considering you had $25,000 in renovation costs that you had to pay off, let's say as a real world example, because this is typically how it goes in reality, you're not going to be able to pull out all of your $30,000 off the bat on day one. Let's say you leave, for the purposes of this example, $10,000 in the deal. You pay off all your contractors, all the real estate taxes are paid up, insurance is paid, you've got a fixed rate 30-year loan, it's cash flowing, you've got a tenant in place, and you get to walk away with $20,000 of the initial $30,000 you put in. You've only left $10,000 in the deal, because quite honestly, realistically, that is how it works out many times. You don't always get to pull all of your cash out right off the bat, but that's okay, and here's why. For a $10,000 investment, you now have a property that is cash flowing in year one, a gross income of $18,000 plus the equity value on the house, that 30% equity that you own, because remember, the bank refinanced it at 70% of its value. So that extra 30% goes on your net worth. Your net worth has just increased by $55,500, and you have a gross income of $18,000 in year one, all for a $10,000 investment. Only in real estate can you get returns like that. Now you save up a little bit more money, especially since you have $18,000 in extra income coming in this year, and you go out and repeat the process. The last part of the Bur Method strategy, repeating it. Suddenly 10 years has flown by and you've been out buying properties and increasing the size of your portfolio. And in the meantime, you've done the occasional maintenance and repair issue at this property that we started with, but your tenants have been good. You've slowly increased the rents, as you should be as a conscious landlord, to stay in line with what the market rents are in your area, and they've been paying them. You've had great success with this property, and for 10 years, your tenant's rent has been paying down your 30-year fixed rate mortgage that you took out 10 years ago. So now let's check back in on the value of this property. And don't forget, we're going to give you a conservative capital appreciation rate of 3% per year. That's in line with the national average. 3% capital appreciation per year means every year the value of your property has gone up 3%. So 10 years on, let's run the numbers. Using a 3.5% interest rate on a traditional fully amortizing 30-year mortgage, by the end of year 10, your initial mortgage of $129,500 is now only carrying a balance of $100,268. Your property's value has increased based on our 3% per year conservative estimate to a value of $248,625, which means your net worth capital appreciation has increased by $148,356.73 from owning this one property. You've been enjoying the benefits of tax depreciation every year to reduce your taxable income. But you also now are able to refinance this property, again at a 70% loan-to-value ratio, and pull out 30% of the now value of the property. that capital appreciation in the form of cash. That 30% equity value is $74,037.50 in cash from the $10,000 that you left in the deal 10 years ago. And on top of that, the annual rental income you've been collecting for the last 10 years. And the best part is it is completely tax-free. You don't owe 1 penny on taxes on it. You know why? Because it's not income. It's a debt. It has to be repaid to the bank. It is a mortgage loan, but you're not going to pay it. Your tenants are going to do that for you. That is $74,000 tax-free in your pocket. But it's been 10 years that you've owned this property. And in the meantime, you went out and bought others. You repeated that process. So now, let's say you own at least 5, maybe 10 additional properties at least. Imagine once a year doing a cash out refi on your other cash flowing properties. Talk about financial freedom. By the time you get through your properties, it may be time to revisit this property for a refinance and another cash out. My hope is that this video opened your eyes to the potential that real estate investing and the power of capital appreciation can provide for you and your family. It truly is life-changing. If you like what we reviewed here today, do me a favor and smash that like button, and of course, hit subscribe. Join us. Join our Confident Real Estate family. We are growing, and we want you to be a part of it. Don't miss out. If you have any questions or comments about anything we reviewed in this video or about real estate investing in general, that's what the comments section is for down below. Please don't hesitate to leave us a question or comment. Otherwise, I appreciate you watching. Until next time.